After the Fed instituted its radical monetary policies during the financial crisis, companies, even junk-rated companies, were encouraged to borrow large amounts at artificially low rates from investors whose brains had been fried by said monetary policies. These investors were out there chasing yield in an environment of total yield repression of the type the world had never seen before. And these investors took on large risks just to gain a little extra yield. Corporate borrowers were more than happy to give these investors what they were clamoring for, and these companies issued record amounts of new debt for investors to splurge on. Many of these corporate borrowers have been cash flow negative. They burned the proceeds from this debt in their operations, and then they borrowed more to have more fuel to burn, and then they burned this fuel too. Other companies have borrowed large amounts to buy back their own shares, and others have borrowed large amounts to buy other companies that already had too much debt. And some of these companies borrowed vast amounts to do all three of these things. But the debt they hold doesn't go away. It just balloons. This debt is still out there and needs to be refinanced, and interest payments need to be made on it, and investors are not getting nervous. So this is the credit market. But by what mechanism will this corporate debt bubble bleed into the stock market and crush stocks? Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com, and you're listening to the Wall Street Report. It's December 30th, 2018. A larger economy can digest more debt. A common way to compare debt to the economy is by comparing debt to GDP. Corporate debt as a percent of GDP is now the highest ever, even higher than it had been during the financial crisis. And worse, much of this debt is junk-rated or near junk-rated. There are $1.3 trillion in junk-rated bonds out there, $1.3 trillion in junk-rated leveraged loans, and $2.2 trillion in triple B-rated bonds. Triple B is the lowest investment grade rating. A downgrade to double B puts this debt into junk category. Just in these three segments, there are $4.8 trillion in publicly traded debt that is already junk rated or is only a hair from being junk rated. This is considered fairly risky debt, carried by companies that have too much debt and not enough cash flow, and whose cash flow may be at risk from competitive and economic pressures. In addition, there are about $1.6 trillion in investment-grade debt above triple B. There are about $2.3 trillion in commercial and industrial loans that banks hold. There are commercial real estate loans, etc., etc. In addition, there's over $500 billion in debt that often unrated mid-sized companies have borrowed from non-banks, such as PE firms. Banks would have provided the cheapest loans, but banks have been more careful with riskier companies and dubious collateral, so PE firms have jumped into this so-called direct lending. But PE firms have a much shorter fuse. They're not a bank that cares about long-term relationships with its commercial customers. They will strip out assets and rip apart a company and pull out the best parts for themselves before the leftover shell is sent into bankruptcy court. PE firms have a long history of doing just that. So this corporate debt is a powder keg waiting to explode, company by company. It came into being as a result of the Fed's experimental and radical monetary policies, but the Fed has now fingered corporate debt as a risk to financial stability in its first ever financial stability report, and it's very gradually unwinding its experimental monetary policies to very gradually deflate the corporate debt balloon. This is too little too late, but the Fed doesn't want to blow down our financial house of cards all at once. So far, corporate debt has held up well, but there are now all kinds of signs that this era of tranquility is ending. Interest rates are rising. In addition, the difference between risky corporate debt and U.S. Treasury securities has been widening rapidly since October. This spread is a sign that investors suddenly start seeing the risks that they were blind to before. And the U.S. economy isn't even in a recession yet. In 2018, economic growth has been strong, but there will be a downturn. It's part of the business cycle. And there will be a recession, and that too is part of the business cycle. It will hurt cash flows, which will reduce the company's ability to service the debts and it will get messy. This new awareness of risk among investors will make it much harder and much more expensive for these companies to refinance their debts and to borrow more money to burn in their operations. And when these companies can no longer borrow, they have to default on their massive pile of debt. So how will this impact stocks? Stockholders are at the very bottom of the capital structure of a company. When a company defaults on its debts, stockholders lose control and creditors take over, with secured creditors at the top. Those debts will be restructured, most often in bankruptcy court. In that process, shareholders get wiped out or mostly wiped out. In a bankruptcy, usually the old shares get canceled and the old shareholders are dispossessed. A new company emerges with new shareholders. Those new shareholders are former creditors and the new executive team, which is often the old executive team that caused all this to happen in the first place. And the old shares go to zero. This scenario assumes that the restructured company can emerge from bankruptcy as a going concern and can stand on its own 2 feet. If this is not the case, the company will be liquidated, its assets will be sold in bankruptcy auctions, and creditors get whatever the proceeds may be based on their position in the capital structure. Some creditors may come out okay, others may largely be wiped out. But shareholders are not even at the table in either scenario. Corporate history is full of these cases where old shareholders get wiped out. This includes nearly all airlines in the United States, dozens of them. Many have been liquidated. Several have emerged from bankruptcy and exist today, including Delta, American Airlines, and United Airlines. Among the most glorious bankruptcies are Enron, WorldCom, and Lehman Brothers. Current examples include a number of large retailers such as Toys R Us and Sears Holdings. A gaggle of oil and gas companies went bankrupt during the oil bust in 2015 and 2016. Parker Drilling went bankrupt a couple of weeks ago. Just about all major coal miners have gone bankrupt, some of them more than once. The U.S. bankruptcy industry knows how to handle this, but the old stockholders of these companies have lost everything. When a company gets in trouble with its debts, creditors take over. There is a legal process for dispossessing shareholders and giving creditors control. This can be done under the supervision of a judge in bankruptcy court, or it can be done outside of bankruptcy court. The stock market today is full of companies that are facing debt challenges. Plenty of them will default. Not all at once, but one after the other, company by company, spread out over a few years. These may be good businesses that cannot survive in the current form because they have too much debt, and they will restructure this debt, likely in bankruptcy court, and they will emerge as new companies with trimmed down debts and new shareholders. And after they emerge from bankruptcy, these companies are more competitive, and they will thrive and invest in productive activities and grow again. So this is a healthy cleansing process. It's part of the business cycle. But for stockholders, it's a moment of real-world reckoning and total losses. This process should have been allowed to fully play out during the financial crisis, but it was stopped by the Fed after the process had barely started. At the time, everything else was blowing up too, including mortgages and consumer debts. Banks were toppling and credit was freezing up in the credit-dependent economy, and there was a financial panic, and the Fed moved its biggest levers to stop it all. And it stopped the cleanup process in the corporate sector before it could be completed. This is part of the problem with the current debt bubble. The old debt bubble was never fully cleared out. Now, corporate debt is a problem of historic proportions. Banks are on the hook for a relatively small portion of it, and their loans are backed by the best collateral, so for them, their loans aren't total losses, and banks are capitalized enough to take some big losses without toppling. But investors from mom-and-pop portfolios to Japan's giant pension fund are on the hook for the vast majority of this corporate debt. The majority of the losses of this debt will be eaten by these investors, not by banks. And the old stockholders are summarily dispossessed. As long as the biggest banks are holding up, the Fed will allow this debt to blow up. This will not happen all at once, but company by company spread out over the years. The bankruptcy industry will get busy and make money hand over fist, from bankruptcy law firms and restructuring specialists to firms that specialize in disposing of assets, such as selling the inventories and stores of Toys R Us. The system in the U.S. is set up to handle waves of bankruptcies. The courts exist. The legal framework is well established. It is not difficult to sell collateral. The process is messy, and there are plenty of murky dealings, behind-the-scenes arrangements, and other things. But there are also big opportunities in it, and a lot of money will be made. And in the long run, this cleanup process is essential for a healthy economy going forward. But the old stockholders will get creamed. This doesn't happen overnight. Generally, when a company gets into trouble, markets figure this out, and shares start plunging well ahead of a default. Eventually, these shares are removed from various indices, such as the S&P 500, and eventually they're banished from the big stock exchanges, and they're relegated to trade over the counter as penny stocks, and eventually they'll just die and disappear. If it's one or two companies every now and then, it's not a big deal for the markets overall. But there is a wave of these credit events coming. Some of these companies are big. Some of them still have high share prices and are a year or two away from hitting the wall. But this debt is inescapable, and it will have to be dealt with one way or the other. And this is one of the big headwinds the stock market gets to look forward to. Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com, and you listened to the Wolf Street Report. I wish you a healthy, happy, prosperous, and all-around awesome 2019.